Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Headache time again, I'm afraid, headache time. I again must apologize for the multitude of lines and labels that I've drawn and I've kept, when I've drawn them, on this daily chart. However, technically there's still a lot going on here, and these labels and lines are all valid in my deciphering and sometimes trying to decipher what is happening here. Okay, so instead of giving a huge history on this, I will instead talk about the action from the peak in May and reference earlier pieces as I deem necessary if they happen. The market's rise in May was up to the neckline of the August to November 2021 complex triple top, currently at 2047, breaching it ever so slightly before the rally failed, and we've seen prices drop, gapping lower until even today. Well, until Friday. The mess of congestion support was seen around the middle time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1918, mainly the combination of the February 21 high at 1894, the medium moving average, currently 1907, the long moving average, 1912, that is currently, and the short medium moving average, currently 1911, eroded the bearishness on the way down from the start of May until the middle of the month, such that though prices pushed below all of them, the market did not have the immediate energy or further impetus to aggressively push any further lower. For instance, with support below the congestion from February this year between approximately 1840 to 1800, within this congestion notably sits the 50% absolute Fibonacci line for 2021 at 1809. However, today Friday the market made a major move lower, a gapping move lower since filled in, that has pushed down through the majority of the 1840 to 1800 support. Interestingly, pushing through the 50% absolute Fibonacci line for the 21st century at 1809, but halting just underneath it. That looks like a case of roundophobia, a little ahead of the 1800 number. This was down with a gapping lower on the open move last Friday, since filled in, a likely changeover I suppose, that still leaves the questions open as to whether the 50% absolute Fibonacci line for the 21st century has been breached or broken. So for all this action, where has that left us apart from confused again? Well, things are surprisingly becoming clearer. The market is now between the overhead middle time of the big December 2020 to April 2021 bullish shift pitchfork, currently at 1918, and the lower time, currently 1692. Now, it's a big pitchfork. This pitchfork is still valid. That's a longer term pattern. At the same time, it's now heading towards the as yet unverified lower time, currently 1788, of the early April to mid-May bearish shift pitchfork. This is a descending pitchfork, so support drops by about 0.01 cents a session. Below this is a significant 50% Fibonacci line of the March-November 2021 move at 1768. One other thing that has happened this past week, and though lagging, it still adds to the bearish pressure, and that is the dead cross of the short medium moving average, currently 1911, down through the long moving average, currently 1912. You see, we might also soon have a similar dead cross of the short medium moving average, possibly pushing down through what is at the moment sidelining, but possibly soon declining, medium moving average, currently 1907. And that's something to watch, because having two so close together is bound to have a kick-through effect of some form or other. Ice, Europe, white sugar in London. The rise we saw late May going into June started to be corralled on the top side for the most part by the middle time, currently 601.80 of the then newly drawn February to May bullish Andrews pitchfork. The rest of the heavy lifting of resistance was made by the upper time, currently 605.80 of the bullish shift pitchfork with the same move as the bullish Andrews pitchfork. There were also banded resistances that helped cap the rise, starting at 587 all the way up to 608.30. and including the November 2016 high at 590 even and the October 2016 high at 608.30. The congestion was too much for the bullish incentive, and 4 weeks ago the market made a weekly key reversal down in response. 3 weeks ago, the market went through a period of indecision caught between roughly 555 even below and 570 even above. On Tuesday 2 weeks ago, the market made up its mind and dropped down through the base of this congestion as well as the middle time, currently 567.10 of the newly drawn shallower bullish shift pitchfork for the same move as the bullish Andrews pitchfork, as well as the lower time, currently 556.30 of the more acute bullish Andrews pitchfork. The key move lower was last Monday when we had what looked like an attempt down to the rising medium moving average, currently 538.10, but couldn't quite make it. Indeed, in the end, the market made a 3-day bullish morning star pattern that caused prices to move back up over the March 2017 high at 548.70, the flatlining short-medium moving average, currently 549.50, and even for a while back up over the supposedly broken lower time. We've had attempts under the broken lower time, but for a large part the closes have been over, and most definitely after the 3-day attempt lower over the 2017 high and the short-medium moving average. Today is the first day of possibly market making an open, high, lower, maybe even a close below the lower time, which is significant. Meanwhile, further down we have target X in the 528 even area. This came about by my musing 2 weeks ago as to whether the action over June was a version of a bearish halfway hesitation, hence the potential target X in the 528 even area as a possible target for such a pattern. Yet there are plenty of things in the way before the market gets there. For starters, we have the medium moving average, currently 538.10. Then an old gap from March 2017 between 531.70 and 532.70 that may well still have some life in it. And then an interesting one, the neckline of the August to December 2021 complex head and shoulders top, currently at 530.90. And then and only then will the market reach target X. Now that's going to be quite some journey if it makes it. Sugar white premium spread. 2 weeks of consecutive indecisive spinning tops right at the top of the market led to the unusual bearish engulfing pattern 2 weeks ago. This was after reaching target X recently at 162 even. You see, target X is from the key pattern in recent times, what was eventually the bullish ascending wedge pattern formed between June last year and March this year. This was once the market had finally made sense of the false break higher, then lower, then back up again from this ascending wedge pattern. Now don't get me wrong, this is a reasonably good looking pattern. I would not normally expect problems such as this. However, problems are what started to happen when prices reached the final part of the pattern. And it was only the weekly key reversal up made 8 weeks ago that finally decided the matter. Then, last week, after breaking down the previous week below the middle time, currently 139.5 of the 2019 to 2021 bullish Andrews pitchfork, prices turned back up again with an immediate countering bullish piercing line pattern and bullish double. This is important as the only pattern still left standing is the 2019 to 2021 bullish Andrews pitchfork. The market is currently in between the middle time below, currently at 139.50, and the upper time above, currently at 213.75. Nearby, we have the 2013 high at 152.75, and then the old target X in the 162 area. Looking above beyond target X, we have a secondary harder to achieve target X1 for the old ascending wedge pattern, higher up in the 191.5 area and just off the top of my daily chart. Wouldn't it be just? Finally, I added the following comments a few weeks ago, and I quote, "I know that these are humongously big asks, but that is what I see. It depends on one thing, and one thing only, that prices maintain contact with the middle time or break upwards, clear of it." End of quote. Well, so far prices have broken up through the middle time and seemingly consolidated, but are still looking suspect up here, despite last week's immediate countering bullish action. We now wait and see what the market will make of this reactionary pattern and if the harder to get target X1 is achievable. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investors International Limited. Here comes the final bit.